Hi, I'm Leena Rao. Welcome to Ask a VC, where we put VCs in the hot seat. Today we're joined by DFJ Managing Director Josh Stein. Josh, welcome.
Thank you.
I'm especially excited because we are in our new Ask a VC studio. So thank you so much for joining us on this inaugural day in the set. I want to go into just a few of your investments before we start. You've backed and invested in Box, Chartbeat, LendKey, Selligy, SugarCRM, Swell, AngelList, Redfin, Tremor Video, and Twilio. Quite a portfolio of diverse companies, not just enterprise, but also consumer.
Yep.
But I want to talk a little bit about how you find a lot of these companies really early. Mm-hmm. You know, you've mentioned that you are sometimes the first check when they're only a team of 2 or 3 people.
Yep.
I know that was the way with Box and SugarCRM and a few others. At that stage, is it about the idea? Is it about the founder? What are you looking for, and what's triggering in your mind?
We're looking for great people who can sell us and get us hooked on an idea. And the idea often changes pretty fast as they build the company, but it's about great people who are motivated less by money, but by wanting to change some problem, and who are really persistent. It's really hard to build a startup, so you're looking for people that are going to stick with it.
So what was it about Aaron and Dylan from Box that first kind of caught you?
Great product, very smart guys, very passionate. In our first meeting, I asked them a ton of questions. They knew rock solid answers to about half of them. The ones they didn't, they said they didn't know, and by 2 a.m. that night, they sent me like a 15-page document answering them.
Wow.
Yeah.
And what about some of the other entrepreneurs that you've worked with?
Yeah, similar stuff. You know, SugarCRM was 3 guys in a room. They built a product just with the 3 of them that was, I would say, 80% feature complete with Salesforce. You know, if you look at Glenn Kelman from Redfin as an example, you know, just this burning passion, not to make money, but to do what's right by the customer, you know, just so incensed with how backwards the real estate industry is, and just having this burning desire to fix it. I mean, he gets viscerally angry when he talks about how backwards the incentives are. Those are the people who really build the great businesses. What
do you think the biggest change in the entrepreneur has been? Because you've been doing this now 10 years. You've seen probably countless, I don't know, thousands of companies, more.
Yeah, probably.
How has the entrepreneur evolved over the past 10 years?
I think that entrepreneurs have gotten even younger, and part of it is there's so much more information about how you start a company and how you raise capital and how you get started. It's also become a lot easier, so the tools and the raw ingredients, like the infrastructure you would need, you can get from AWS or you can get from Twilio, that you'd have to raise a lot of money before, or to spend a lot of time setting up. So it's so much easier to start a company. There's so much better information that I think you're seeing people able to do it even sooner. It also, you can get it started with less money, and so you don't need to, in the old days, you'd have to have 10 years of experience because you needed $5 or $10 million, which is a higher level of trust.
Right.
You know, you can get a great idea started with $50,000, $100,000 now. So I think, you know, younger, and I think also having the benefit of, in every generation, there have been these technical shifts that have made a startup possible. But, you know, with the iPhone, with Android, with SaaS, with the move to moving applications from being delivered locally on a client to being delivered through the web, it's made it so easy for people to bring ideas to fruition.
Well, I want to go into some of our reader questions.
Yeah, sure.
So this one is really interesting. It may actually really put you in the hot seat, but is VC turning into growth equity? VCs increasingly acquire product removing technical risk and substantial revenue, which is removing financial risk. Thus, the only risk left is operational growth. Who is going to fill the risk gap between an idea and a solvent company? Even established angels and seed funds are effectively growth equity now. Messaging to startups is to focus on profitability, not growth. Do you think you agree with that or disagree?
I understand the point. I'm not sure I totally agree with the premise of it, which is, I think, you know, the definition of growth equity in my mind is an investor who believes they've mitigated the loss of risk of capital, so losing your investment, having a zero. And I think almost all the investments that we do at the Series A or Series B level still have that risk of being, if we're wrong, it's a zero, most likely. There's a huge valuation inflection, and always has been, for investors, where once they know they're not going to lose money, it's just a question of what's the return, and it gets much more of a commodity, the money. I do think that one thing you're seeing is people, because it is cheaper to start a company and it's faster, because, like, you know, AWS, as opposed to having to buy and set up infrastructure, for example, companies have more traction now when they're approaching a VC than they did 5 or 10 years ago. So they will often have a shipping product. They will often have revenue. If someone came to me today with an idea for a SaaS company and they didn't have at least an MVP built, or if they didn't have at least customers they were talking to,
right.
I would probably say to them, why don't you go do that and come back and talk to us? Because it's so easy to get started and get those things going. You're talking about a couple of months and maybe $50,000 or $100,000 to get that done, as opposed to 2 years ago. You know, I would say when I was an entrepreneur 10 years ago, it might take you 18 months to get to that stage.
You know, like kind of dovetailing off of that, I mean, a lot of entrepreneurs, founders, investors talk about product market fit.
Yep.
And when do you expect an entrepreneur or founder to have that? Is that post-seed? I mean, as you said, you know, it's easier to build a company. Sometimes apps have already been launched by the time they get seed funding. When do you find product market fit?
So I actually think product market fit is a moving target that changes over. I don't think it's something you achieve and then it's set in stone. So, you know, Box is a good example of the initial product market fit was more consumer oriented, and then we pivoted into enterprise over time. I think what you're showing an investor when you say I've got more than, let's say, a dozen or two people paying me to use my product, is that you're able to listen to customers, that you're able to execute on a technology, and you're able to execute on a basic sales and marketing strategy. So it's almost more, I'm looking more for a demonstration of a skill set and competence than like a static concept of, aha, now the product is proven.
Right.
Which, to that person's question, I don't think the risk is removed, because I think they're underestimating the degree to which things continue to evolve over time. If that makes sense.
What's another company, you know, we use Box a little bit, but you know, I'm really curious, you know, SugarCRM, you also invested fairly early. So, you know, in terms of that journey, were they also kind of, did they shift product market fit, you know, in any way?
Yeah, definitely. So, so when we invested in SugarCRM, again, it was, you know, 3 guys in a single room, and they had released the product for free on SourceForge, which was kind of the thing back then for open source projects. And so what we were able to invest in was seeing that first they were able to build a product that was functional. It looked like it was, you know, somewhat feature comparable with Salesforce. But also you could see the downloads. So it was people were downloading the product for free, and they were also interestingly starting to translate it into lots of languages, so you could feel like there was this ecosystem that was going to be built around it. But they hadn't sold anything yet, so there was zero revenue when we invested. Over time, if you look at Sugar today, the open source aspect of it is still important, but it's actually become more about an architectural differentiation and almost a philosophy of CRM about being for the user. So it's really, you know, evolved quite a bit, where it used to be about if you were an open source person, you would have a bias towards SugarCRM. Now it's actually really different, if that makes sense.
Mm-hmm. Yeah. That does make sense. So moving on to another one of your investments, AngelList.
Yeah.
You know, certainly a platform that's changed a lot of the ways that seed stage investing is done. Investors are interacting with founders in a completely different way.
Yep.
One of the questions we had was, is this sort of the future of investing, and could this eventually replace VCs one day? So I'm curious, you know, how you feel about that, because you're an investor, but there's been a lot of talk that, you know, is AngelList going to be the seed stage, you know, de facto, you know, vehicle?
I think people sometimes think too zero sum. I actually think AngelList complements VC and is like an accelerator for both VCs and for entrepreneurs, and it's going to make that matching process. VCs want to get capital to great entrepreneurs, just like great entrepreneurs want the capital, and so AngelList makes it easier for us to connect. I think that's a net win-win for everybody, and including AngelList. So like the syndicates product, for example, I think is going to make it easier for very influential angels to bring more money to bear and make it more worthwhile for them to do that. I think that helps VC rather than hurting it. I think.
Do you guys have a syndicate?
We have not done a syndicate, and partially because, you know, we haven't quite figured out how that interacts with our model. We raise money from our limited partners to invest it, but we've done a number of deals from AngelList that we sourced from AngelList, and it's been a very effective source of deal flow for us. That's what I mean when I say it's win-win, where it's been a deal for us, and it's also helped the entrepreneur get funded.
It's funny, I saw a tweet just a few hours ago that said, like, if you're an investor and you're not on AngelList, that's like a red flag.
I think that's right. I think it would be like not being on Twitter or being on LinkedIn.
Right.
Because I do think it's an important way in which people are interacting. I think what Naval has done at AngelList is remarkable. I've known Naval for 20 years, and he is hands down one of the smartest people I've ever met. And I could have made the AngelList investment just based simply on that fact, but we also think that they have a remarkable position in the market.
Well, thanks so much, Josh. I really appreciate you coming by the new studio.
Looks great.
Thanks.